Additional activities are also envisaged, at least on the defense side. With the changes on the global level, the war in Ukraine and particularly aggressive Russia coming closer to us, we have seen some initiatives on the European level to do kind of harmonized and mutualized defense policies. There have been escape clauses regarding expenditure for defense. There have been some European programs brought up, but we have seen that also including Italy and Spain, a couple of European countries do not want to use this additional room, at least the European rules provide, because they say, look at our budget situation, we simply can't afford doing this. And in that respect, we think that with those countries not using it, although they have pledged, with the exception of Spain, that they would spend 3.5% in extra or in defense and 1.5% in the defense-related infrastructure, that there is more pressure in mutualizing expenditures for defense. And I think in this respect, we will see some movement in the next couple of months. Now, Germany, which has the fiscal room, both on the private and on the public side so far, they came up with one big expenditure program for defense. You see on this left-hand chart here that we have seen already quite a significant increase in defense expenditure in Germany, and the plans are that this is increasing even further. Now, the problem is that Germany does not have the own capacities doing this. So it would be probably a good thing to have their corporations in Europe that might be under one European particular leg amongst the NATO or some kind of EU defense activities. But this chart here on the defense side shows a bit the view of, do defense expenditure really have a positive impact on growth? So the first package, when defense expenditure in Germany went up by around 100 billion. Around of this 100 billion, which are there, but have been funded, only around 70% were imported. So there is no growth, economic growth implications from these expenditures at all. So what you have to do, and that's also true for the other expenditures, what Germany has in the offing, you have to provide private investment to have the production capacities to do so. So only government spending alone will not fix our growth and structural problems. On the right-hand chart here, we put in together all of the plan. We still don't know the full plan of this German expenditure plans going forward. So there's a bit coming in this year, then a huge amount in 26 and 27, and the peak, the absolute peak of these expenditures will be in 28. So thinking, take just away that not all of this is really produced and kept within the country or in Europe, you would have the peak of the contribution to growth, what is always an annual change, in the year 28. From then onwards, you will have a negative contribution from this program because the absolute expenditures are going down again. So what you need is something that is not only able to feed through those expenditures to economic activity, but you have to do something to propel overall underlying productivity and the growth potential. And we were, I would say, generous, assuming that we get quite a bit of structural reform, not just on the social security schemes, but also in terms of propelling innovation, not just in Germany, but in Europe in total. We have kind of changed our growth forecast for Germany because of this program. So the dotted line here shows you the overall GDP development, what we have based as 100 in the year 24 for the next 10 years without the program and with the program. And we would come up with a kind of around 3-4% or 4.5% higher overall GDP level in Germany because of this program in the year 2034, but it comes at a cost. because of the implication on the interest rate side, but also because of the simple need for funding more. The debt to GDP ratio in Germany is like to mount from a bit more than 60% to almost 90%. So this growth initiatives comes at a cost. And it would be, in our view, a great idea, not just to spend the money, but to kind of support this with structural reforms. Now, I talked about you need the capacities for these expenditures in the country to go ahead. We see actually positive signs on the investment plans of German corporations, and therefore we are quite confident that there will be an increase in investment in Germany coming through, where not just the German investment activity is likely to be benefiting from, but also Italy and other places in the European Union, which will benefit from this. So one view what the financial environment means to this. As I said, and I already alluded to it, we think that the ECB will come down with rates to 2%, but because of those reasons, this crowding out from this huge amount of government issues, we think that the bond yields for bonds are likely to increase, but we also see some further mutualization to come through. So the spreads from Italy, from France, from others towards Europe among the next couple of years are likely to come down again. Now, talking about the market view, I found it quite exceptional what happened after the announcement of this German fiscal package on capital markets. We all had in mind what happened in 2023 in the UK, where the Prime Minister at that time decided to go for a huge debt-funded stimulus package. And this package actually did not receive applause from the markets. We actually had a crash in the gilt market, and this was a big shock to markets at that stage. Now, Germany tried the same thing. And what we have seen, this was Ash Wednesday in Germany, so they did not celebrate too much Carnival that time, but it was just this announcement on Shrove Tuesday that there would be this massive fiscal program. And we saw that bond yields really jumped. It was the biggest jump since German unification. What did not happen, and that was different to that what we have seen in the UK, that the CDS spreads, what is more or less a measure for the solidity of the government funding, that did not go up. And therefore, I think financial markets believe that this extra spending Germany is going for, although it creates additional debt, that Germany over the long run is able to repay this debt because of higher growth potential, what is coming up. Now we have seen that the CDS rates were falling even more, although part of this plans for Germany to invest those more than 500 billion were watered down. We see now more and more a kind of loopholes in this investment plans that suggest that quite a big chunk now is going into government consumption. And unfortunately, if you consume it, it is not invested in machinery, it is not invested in infrastructure, it's not invested in education, and therefore it's unlikely to propel growth through a better capacity situation in the future. So I see some risk here that the market is getting a bit more nervous of this fiscal situation in Germany going forward. Where the market got nervous was not Italy, it was France in the recent past, where last year we had this election in France, and with this uncertainty on the political side, we have seen that the spreads of the OATs, these are the French government bonds and German bonds, have been widening quite substantially. And also the recent amount of tensions have been taken by the market with some cautious. And therefore, we think that in contrast to this, what we had in previous years, where an expansion of fiscal policy was seen always as a good sign by markets, the markets are now more kind of differentiating who is doing it. And if your funding is already at risk, the markets are not likely to tolerate this. This holds for France, but this particularly also holds for the US, as I said, the biggest and important bond market in the world. Now, looking at equity markets for a second, we see record high valuations, not just in the US, but also in European markets. And therefore, the risk of a contraction at some stage is increasing. But for the time being, we have keep seeing very good data from the revenue side, and institutional investors are not overly euphoric about the situation. They're still, if you look at sentiment figures, are still in a more of a rational camp. And so far, we might go ahead seeing quite a bit more of a rally till the end of the year. But in my view, I said it earlier, there might be a correction taking place. Now, just a few thoughts about the longer term implications. I was talking about megatrends and Ds determining the future for a while. It used to be 4 Ds, namely demographic change, deglobalization, digitization, and decarbonization. Those 4 Ds still hold, but they have been kind of widened by 2 more Ds, namely defense and debt. And I think those 6 Ds now are really important for the developments of every country. So every country has to find a way to deal with this. And in most of the countries, demographic change and deglobalization, or de-risking, or however you want to name it, this is really a kind of a pressure on growth taking place. On digitization, here we have the focus on artificial intelligence, robotics, virtual reality, quantum computing. The US, they are more innovative. They have invested more in this. They are still leading. And it takes a lot also from the labor market to stop this. I always call it the kind of the Wimbledon effect. The UK and Wimbledon, that's not the place of the best English tennis players, but the tennis players from the world came there to do a great tournament. Silicon Valley is a bit of a similar thing. There are not only American scientists working, there are people from all over the world. And if you make it very unattractive to get there with lots of restrictions, that might be some harm to this expansion on the digital side for the US to take place. But we're far away having this. But over time, that might really jeopardize it. So looking at this AI boom, I think in many respects, and seeing all of the circularity in the deals, what you see in the sector, I think we are close to a peak, at least the short term. And if you look at megatrends, you have a hype, then more or less a slowdown, and then the broad wave of this comes through. And the broad wave really might come through if you have cheap energy, what is, in my view, the most crucial part of having a broad-based rollout of AI activities in the economy. And this is more likely to be than the case in 5 to 10 years, where we are also likely to see huge increases in productivity. In terms of decarbonization, I think we also passed the peak. We have seen a completely political turnaround in the US, and we also see more pressure on the European side to look through all of those rules. There might be very good things coming through, that in Europe we declutter our regulatory regime in this respect, because many of the things, particularly in the financial sector, what were aimed to reduce CO2 emissions were not really targeted. It only created a huge amount of red tape without having a more efficient energy production or production processes coming through. So I think as well here we might have a bit of a difficult thing, but with climate change and all of those things are not going away, I think this wave in decarbonization is likely to continue. And now looking at defense and debt, these are 2 things coming together. I talked about debt a bit. Defense could be over time a huge source, not just for overall productivity, but also for technological progress. And this is really one source where things could get better, particularly in Euro again, if we do it together. And in that respect, there might be good things to do it. On the funding of defense, if you think about it as an insurance, it does not really make sense to fund defense with debt. defense should be funded by the regular revenues, mainly for government with taxes. And comparing this with the company, if you build a new factory, it would be the normal thing to take up a loan for this. But you would not go to a bank and take up a loan to pay your fire insurance. And I think this is a kind of a similar situation here. You have to find a way after you made this kind of catch up investment, what is completely fine doing this by debt. You have to find a way to do this on a sustainable basis in funding this. And on the debt side, I already said, we are having not just in the government sector, but also parts of the private sector, very high debt figures. You can keep going with this, as we have seen in Japan, but at some point, you have to find additional buyers for that, and that might become increasingly difficult. So that leads me to the longer term outlook, saying that the US is still like to lead on the innovation and digitalization front. We like to see decent growth there. Europe is likely to hold up because we think we make something out of this sandwich position. I believe that we get at least some more mutualization and common ground going ahead in Europe. And this is kind of the underlying thought here, that we have okayish growth in Europe, in contrast to the US, where this taking away the independence of the Fed will lead to another wave of inflation building up. The ECB is likely to keep and go ahead with its mandate and keeping inflation low. But that means then over the longer term as well, that interest rates are likely to stay somewhat higher. We have then rates going to 3.5% for bonds, and then probably somewhat more than 4% for government securities in Italy. Last words on the exchange rate. We see here that in line with the interest rate differential, where the US, also because of this inflation expectations, are likely to go higher, then we think that more mutualization in Europe will be one factor driving a stronger euro, but as well this loss in confidence in the US, and probably then with the second term of the Trump administration from 29 onwards, no, third term of the Trump or Trump-like administration, put it this way, from 29 onwards, we see the euro above 140. That would be then some overvaluation if you put it in the purchasing power parity, what is still around 132, 134, but it would end the period of an overvaluation of the dollar and getting to a more balanced view here. A very last word on real estate markets, because of higher interest rates, what is then kind of a collateral damage of those fiscal programs. We see still some correction in the commercial real estate markets, particularly in Europe, where we had some corrections already. Italy is here an exemption. We are still quite constructive for the Italian market. And also for the residential market, where we see kind of a stabilization, and looking for the construction sector in this environment. They're probably happy and getting lots of kind of orders in the terms of civil engineering, but when it comes to building new houses, it might be a bit more reluctant. So overall, the title was a challenging environment, and Europe, as we heard at the beginning, is in a sandwich position. I hope that we get our things together and let the rest of the world know how flavorful Europe can be. And with this kind of more upbeat note, I end here and give back to Jörg Bock and the round of questions that might come from your side.
Thank you. Thank you very much. Thank you very much, Dr. Michel. Thank you very much to Landesbank Bayern for perfect presentation and your outlook on what the upcoming stuff.